Coming up on the SBS On the Money Markets podcast, the development in Venezuela. What does it mean for oil prices and for petrol? And we take a look at the investment themes for 2026. All of that and more next. Hi everyone, welcome to the SBS On the Money Markets podcast for this Monday, the 5th of January 2026. It's a day where not much actually happened on the Australian share market. The S&P ASX 200 steady at 8,728. We'll take a look at why, but also take a closer look at the investment themes for the new year with Armina Rosenberg from Minatour Capital in a few moments. But first, to the developments in Venezuela, where OPEC data shows Venezuela had the largest crude oil reserves in the world in 2024 at 303 billion barrels. That's ahead of Saudi Arabia and Iran. The US, in comparison, only had around 43 billion. But the US is the world's largest producer, followed by Russia and Saudi Arabia. Analysts say Venezuelan oil is harder to work with and needs special extracting techniques and thus investment, while sanctions, especially from the US, have kept a lid on production and exports. So, with the developments in Venezuela, what does it mean for oil prices and for petrol? For that and more, I spoke with Saul Kavonic, the head of energy research at MST Marquee. Saul, firstly, what's the development in Venezuela likely to mean for global oil prices, given the reaction so far seems to be quite muted?
Well, we have seen a very subdued reaction from the market with the oil price not moving much, but we shouldn't mistake that for this not being important. Venezuela produces just under 1% of global supply, and that is a very significant amount. And more importantly, if investment was to return to Venezuela, that number could double or triple over the next several years, which would make it one of the largest producers of oil in the world. Now, the reason the market hasn't moved much is because there's been a high degree of ambivalence here. The market's weighing up the near-term disruption because of the conflict and the uncertainty that's currently underway. But that's been counteracted by the prospect of more supply coming alongside in the medium term if the Trump administration is successful in seeing a transition to a more pro-US and pro-investment government in Venezuela. The second part of that is the market was looking to become oversupplied over the next several months anyway. And so there is a lot of alternative sources of supply available to fill any immediate gaps in supply that are caused by the current developments in Venezuela.
Okay, so longer term, is there the major potential for an easing in prices and thus inflation?
Yes. So if Trump realizes his ambitions here and we see a more mainstream pro-Western government materialize in Venezuela, now there's a number of hurdles that would still have to be overcome, but that could start to see a lot more foreign investment come back into Venezuelan oil, particularly by companies such as Chevron, which are still there and have the backing and support of the US government. If we see a lot more investment return back into Venezuela, it could grow from the recent about 0.8 million barrels a day of supply to the 2 to 3 million barrels a day mark. And in particular, this is the heavy and medium grade sour crudes, which directly compete with OPEC, very important for the US refinery complex. And that could create competition for OPEC and push down prices in the medium term window, really starting from 2027. But there's a lot of geopolitical governance and legal oil and gas framework hurdles that have to be overcome before we will see all that investment come back.
And so finally, we can't necessarily talk oil without talking about what does it mean for me. So in that context, as a motorist, right? What does it mean for motorists here right now? Will there be any impact?
Look, for Aussies at the pump right now, I wouldn't be expecting much change of course. There's the potential here that you see some price relief heading well into 2026 because the market is going to become more oversupplied, quite independent of what's happening in Venezuela. But these Venezuelan developments could see at least some more price relief in 2027 and 2028 compared to what would have been otherwise if Trump had not made this move over the weekend.
Saul Kavonic there from MST Marquee. Let's go to the Australian share market now, which finished flat. The S&P ASX 200 today, 8,728. Sectors ended mixed, most down actually. Only two sectors finished higher. They included the materials and utilities sectors, the worst performing information technology and consumer discretionary. The best performer on the market today, Silex Systems, up by about 9%, and uranium players, the likes of NextGen Energy and Paladin Energy, up by at least 7%. The worst performers, as I mentioned earlier, are technology. Zip, one of the worst, down by 5.6%. Temple & Webster, the online furniture retailer, off by 5.7%. And the biggest loser today, Magellan Financial, off by 5.8%. For more on the day's market action, including the market reaction to the oil price moves, along with her take for the investment themes for 2026, I spoke with Armina Rosenberg, the co-founder at Minatour Capital. Armina, it's the first work day for most of us for 2026, but the market's already been open at least one day last week. Given this is day two for the market, how are you feeling as an investor going into the new year?
Yeah, I think I describe it as constructively cautious. The backdrop for 2026 is unusual. There are real tailwinds like AI, investment and productivity, and easing in some rate cycles. But we're also dealing with high starting valuations, big fiscal debts, geopolitical shocks. So I don't think 2026 is a set and forget year. I think it's a year where markets can still go up, but returns will be more earned than gifted. In 2025, a narrow group did a lot of the heavy lifting. In 2026, we're expecting more dispersion, more differentiation between businesses that have real earnings delivery and those living on just narrative. And that's actually good news for active managers like me. I'm obviously talking my book a bit, but when everything isn't moving together, you can actually add value. So our mindset is stay invested, but be selective, valuation disciplined, and risk aware because volatility is likely to be part of the journey. And 2026 definitely feels like a year where you get paid for being active and selective, not passive and hopeful.
Okay, we'll talk about what you're doing in a few moments. One of the key stories today, and the one making headlines, is that of the development in Venezuela, the way it will impact, I guess, investment sentiment, potentially the global oil market. There hasn't really been an immediate reaction. What's your take?
Yeah, I think in terms of the developments in Venezuela, the market's initial reaction's been muted because Venezuela's not huge in day-to-day global supply and the broader oil market's been well supplied. So traders don't have to price an immediate shortage unless there's a clear sustained disruption. But the near-term risk is real. You know, the reporting suggests PDVSA, which is the state-owned oil company of Venezuela, they've been cutting output because exports are constrained and storage is filling, which can tighten barrels at the margin. I think longer term, though, Venezuela is more about optionality. Like, yes, the reserves are enormous, but rebuilding output meaningfully is a multi-year capital and infrastructure task. So the market won't price a miracle overnight. You're talking years and a very large capital spend to rehabilitate heavy oil infrastructure. So near term, it's a geopolitical risk premium story. Long term, it's a potential supply story, but with a long runway. But at Minatour, we're stock market investors, so where it gets interesting for us is thinking about what listed companies will get paid to do the rebuild. The playbook we focus on is the assets that the world can't afford to let fail. So the early beneficiaries look like, if this normalizes, operators with existing legal standing and boots on the ground, so the likes of Chevron and some European majors. I also think, the fixers, as we call them, they'll be interesting as well. So they're the oil field services companies like Schlumberger and Halliburton, where, Venezuela's heavy crude requires a lot of specialized upgrading and rebuild work, and they do a lot of that. But having said that, we currently have no dog in the fight. Crude oil is a bit of a tough one for us, and I think for a lot of investors, just from that ESG perspective. So I think a lot of people are still in that wait and see mode on that front.
Okay, so this leads us well then into what you think will then be the key investment themes for 2026.
Yeah, I think the key themes for 2026 I group into sort of four buckets. So firstly, the AI build out broadens. It's not just mega cap tech, it's semis and memory, data centers, cloud, cybersecurity, and then the adopters who use AI to lift productivity. But the key is about being selective on who earns the economics. I think second bucket is about power and infrastructure, which is related as well. So AI and electrification are driving a genuine power demand. Grids, generation, picks and shovel infrastructure, all of those come to the fore. I think Brookfield calls it digitalization meeting energy build out. Thirdly, and we've seen this with the Venezuela stuff, economic security and reindustrialization is going to be a big theme this year. That means defense, supply chains, and critical minerals. A more fragmented world means more domestic investment, and geopolitics is going to be a big capex driver. That was true in 2025. I think it still plays out in 2026. And then fourth is a broadening beyond the US. I think there's a credible case for investing in, places like Japan and Korea due to reform and governance there, selective Europe countries, other parts of Asia. Valuation and earnings momentum in those areas are more compelling, and then you're less subject or privy to these geopolitical shocks that you've seen come out of the gate in 2026.
And finally, you alluded to it at the beginning. How are your funds performing, given you use AI instead of a traditional analyst team? And how do you position, I guess, your investment for 2026?
Yeah, so the Minatour Global Opportunities Fund did really well in 2025. We rose 22% net of fees. We beat our benchmark by nearly 8 percentage points. We've done 43% since inception in May 2024. And importantly, we've done that with lower drawdowns than the market, which is significant given the market volatility and everything we've just discussed. On our process, AI accelerates our research leverage across idea generation, filtering and deep investigative work, and monitoring, but the portfolio is still built on fundamentals, valuation, and risk control. So AI doesn't replace human judgment, it compounds it. Positioning wise, we have a very diversified book across tech and healthcare, alongside selective industrials and defensives, playing into those themes that I mentioned. Recently, we've added a lot to our shorts. So where we see late cycle excess or structural headwinds, we've gone short. And a recent example is where shorts select Japanese shipping names due to oversupply. On the AI front, we're focusing more on the second order winners and losers. For example, we have a pairs trade where we've gone long the memory makers, so Micron Technology and SK Hynix, and short the memory takers, so the PC makers where memory is like 10 to 15% of their bill of materials. So that's the likes of HP, Dell, Lenovo, and Asus. They're going to see their gross margins getting crunched over the next year. And finally, we're pretty well diversified across geographies. We're actually underweight the United States relative to benchmark, and we see the opportunities broadening out to other areas of the world, most notably Europe, Korea, China, and Japan. That's about opportunity, but it's just also about that risk mitigation given the climate of geopolitics that we're seeing.
That's Armina Rosenberg there from Minatour Capital. She is the co-founder. That wraps up the podcast for this Monday. Don't forget, if you enjoy it, give it a rating or review on Apple Podcasts and Spotify. Click subscribe, and I'll see you tomorrow.
This SBS on the Money Markets podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.